Preparing for a FP&A Analyst at Penny interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Tell me about yourself and why you want to join Penny as an FP&A Analyst. I am an analyst who enjoys turning detailed financial information into practical decisions. My experience includes budgeting, variance analysis, and building Excel reports for operational teams. Penny appeals to me because discount retail has tight margins, high transaction volumes, and direct links between analysis and store performance. I would bring strong attention to detail, commercial curiosity, and a collaborative style. I am especially motivated by improving forecast quality while helping managers understand the actions behind the numbers. While answering, connect your analytical background to retail economics, explain your interest in Penny's discount model, and demonstrate that you can combine financial discipline, operational curiosity, and clear communication with non-finance stakeholders. Question 2. What does FP&A contribute to a discount retailer like Penny? FP&A gives the business a forward-looking view of performance and the choices required to improve it. At Penny, that means translating store, category, supply chain, and labor drivers into budgets, forecasts, and actionable reporting. The team should explain why results differ from plan, challenge assumptions constructively, and quantify trade-offs. In a discount environment, even small margin or cost movements matter. So FP&A helps leaders protect profitability without losing sight of customer value and operational simplicity. Make sure to cover planning, forecasting, performance reporting, decision support, and business partnering, while linking FP&A work to sales, margins, labor, shrinkage, inventory, costs, cash generation, and disciplined execution. Question 3. How would you build an annual budget for Penny's stores? I would begin with a driver-based baseline rather than simply applying a percentage to last year. I would segment stores by maturity, format, region, and trading profile, then forecast sales using traffic, basket size, pricing, promotions, and calendar effects. Costs would include labor, rent, utilities, logistics, shrink, and maintenance. I would separately model openings, closures, and renovations, review assumptions with operations, run sensitivities, and reconcile the final plan to group targets and capacity constraints. In your answer, talk about historical baselines, store cohorts, openings and closures, like-for-like sales, traffic, basket size, pricing, labor, occupancy, logistics, calendar effects, stakeholder review, and documented assumptions. Question 4. How do you distinguish a forecast from a budget? A budget is the approved financial plan for a defined period and normally establishes targets, resources, and accountability. A forecast is management's latest estimate of what will actually happen, based on current performance and updated assumptions. I would preserve the original budget for variance analysis while refreshing the forecast when trading, costs, or strategic decisions change. Comparing budget, forecast, and actuals helps distinguish execution issues from changed circumstances and improves future planning discipline. Be sure to mention that the budget is an approved target and resource plan, whereas the forecast is an updated estimate, including timing, assumptions, governance, variance interpretation, and how both support accountability. Question 5. Which KPIs would you monitor in Penny's monthly performance review? I would monitor sales, like-for-like growth, transactions, average basket, gross margin, promotional performance, shrink, waste, labor cost, occupancy, logistics expense, and EBITDA. I would also track inventory availability, stock turns, working capital, and relevant service measures because financial results can deteriorate when execution weakens. The key is not producing a long list, it is showing trends, explaining drivers, comparing actuals with budget and forecast, and identifying the few actions most likely to improve performance. Focus on a balanced KPI set covering sales, like-for-like growth, transactions, average basket, gross margin, waste, shrink, labor productivity, operating expenses, EBITDA, cash flow, inventory, and service indicators. Question 6. Sales are below budget, but gross margin percentage is above budget. How would you investigate? I would first quantify the sales shortfall and confirm whether the margin percentage improvement is reliable or timing related. Then I would decompose sales into traffic, transactions, basket, pricing, and mix, while analyzing margin by category, store cluster, and promotion. Higher margin categories may have offset weaker volume, or planned promotions may have shifted between periods. I would validate source data, discuss operational causes with commercial teams, and assess gross profit dollars rather than relying only on the percentage. In your answer, separate volume, price, mix, promotions, markdowns, buying costs, and timing. Quantify the gross profit effect, validate data, investigate store and category patterns, and recommend corrective actions. Question 7. How would you explain a material monthly variance to a store operations director? I would lead with the conclusion. Operating profit was below plan by a specific amount, driven mainly by weaker like-for-like sales and overtime. I would then show a simple bridge from budget to actual, quantify each driver, and separate controllable from external factors. I would avoid finance jargon and ask whether the operational explanation matches reality. Finally, I would agree actions, owners, and timing, then update the forecast if the variance appears recurring rather than isolated. Make sure to cover concise storytelling, driver-based analysis, financial materiality, operational language, evidence, ownership, actions, timing, and a distinction between one-off items and recurring performance issues. Question 8. How would you forecast sales for an existing penny store? I would forecast sales using a combination of historical run rates and operational drivers. For each store, I would examine transactions, average basket, category mix, pricing, promotions, seasonal patterns, holidays, local competition, and recent trading trends. I would adjust for renovations, cannibalization, closures, and unusual events, then compare the bottom-up result with a top-down business target. I would create base, upside, and downside cases so management can understand both the estimate and its uncertainty. Discuss store-level history, like-for-like trends, transactions, basket size, pricing, promotions, seasonality, holidays, competition, cannibalization, local events, weather, and scenario testing before aggregation. Question 9. How would you evaluate whether a promotion was financially successful? I would compare promoted performance with a credible baseline, ideally using similar stores, periods, or products. The analysis would include incremental units, net sales, gross profit, supplier funding, markdowns, waste, and any cannibalization of nearby products. I would also check availability because stock-outs can understate demand. A promotion is successful only if incremental contribution and strategic benefits justify the cost. I would report results by customer and product segment and capture lessons for future planning. Be sure to mention incremental volume, baseline sales, net price, gross margin, supplier funding, cannibalization, stock availability, waste, customer response, and post-promotion behavior rather than judging success by revenue alone. Question 10. What is a driver-based forecast, and why is it useful at Penny? A driver-based forecast links financial outcomes to measurable operating assumptions. For example, sales can be modeled from store count, transactions, average basket, and pricing, while labor cost can reflect hours, wage rates, and productivity. This approach is more transparent than applying a blanket growth rate and makes sensitivities easier to test. It also gives operational owners clear levers to manage. At Penny, that connection is valuable because small changes across many stores can materially affect group results. In your answer, define operational drivers, Explain the link to financial outcomes. Contrast driver-based forecasting with simple percentage extrapolation, and mention transparency, sensitivity analysis, ownership, and faster reforecasting. Question 11. How would you analyze labor cost performance across penny stores? I would separate labor variance into hours, wage rates, staffing mix, overtime, absence, and timing. Then I would compare labor cost as a percentage of sales and sales per labor hour across comparable stores, while considering opening hours, size, workload, and local conditions. A low labor ratio is not automatically positive if availability or service suffers. I would identify outliers, validate operational explanations, and recommend scheduling or productivity actions that protect both customer experience and profitability. Focus on labor dollars and percentage, hours, wage rates, sales per labor hour, staffing requirements, overtime, absence, store size, trading hours, productivity, service quality, and fair peer comparisons. Question 12. What steps would you take to improve the accuracy of a monthly forecast? I would begin by reviewing historical forecast errors for bias, seasonality, and recurring assumptions that proved unrealistic. Next, I would improve the key drivers, clarify ownership, and ensure actuals are complete and consistently defined. I would maintain an assumptions log, discuss changes with operations, and backtest the model against prior periods. A rolling forecast should reflect current information without becoming unnecessarily complex. I would track accuracy by line item and use lessons learned to improve the next cycle. Mention forecast ownership, consistent definitions, actuals quality, driver granularity, bias analysis, rolling updates, assumptions logs, variance backtesting, stakeholder challenge, and balancing accuracy with a practical reporting timetable. Question 13. How would you assess the financial case for opening a new penny store? I would build a store-level model covering fit-out and equipment investment, opening costs, sales ramp, gross margin, labor, rent, utilities, logistics, shrink, working capital, and taxes. I would include cannibalization of nearby stores and separate one-time from recurring costs. The decision should consider NPV, IRR, payback, and strategic factors, supported by downside sensitivities on sales, margin, and construction cost. After opening, I would compare actual ramp-up and profitability with the original investment case. Be sure to cover investment, sales ramp, gross margin, labor, occupancy, logistics, cannibalization, working capital, tax, cash flows, payback, NPV, IRR, sensitivities, and post-opening performance tracking. Question 14. How would you analyze inventory and working capital in a grocery discount business? I would analyze inventory by category, store, and distribution channel using stock turns, days on hand, availability, waste, shrink, and markdowns. I would reconcile purchases, sales, and stock movements, then consider supplier terms and payment timing when assessing cash impact. Excess inventory ties up cash and increases waste, while insufficient stock damages sales and customer trust. My recommendation would balance working capital efficiency with service levels, supported by exception reporting and root cause analysis. Discuss inventory days, stock turns, availability, safety stock, supplier terms, purchase timing, waste, shrink, markdowns, cash conversion, service levels, and the trade-off between working capital and customer availability. Question 15. Describe a time you found an error in a financial report. In a monthly cost report, I noticed a regional expense was materially higher despite stable activity. I reconciled the ledger to the source file and found that a duplicated upload had combined two reporting periods. I confirmed the issue with accounting, corrected the report, and informed my manager before distribution. I then added a duplicate period check and a control total to the process. The experience reinforced that unusual movements should be investigated, not accepted simply because the file balances. In your answer, use a clear situation action result structure, explain the control or reconciliation performed, quantify the impact where possible, communicate promptly, fix the root cause, and describe the preventive control added. Question 16. How do you ensure data quality when working with Excel, ERP, or BI reports? I start by confirming the source, period, entity scope, and definitions of every important field. I reconcile totals to the general ledger or an approved control report, test for missing and duplicate records, and perform reasonableness checks against prior periods. In Excel, I use controlled inputs, consistent formulas, and visible checks. In BI tools, I validate filters and refresh status. I preserve an audit trail and document transformations so another analyst can reproduce the result confidently. Mention source reconciliation, data definitions, period and entity checks, completeness, duplicate testing, control totals, version control, audit trails, reasonableness checks, and documenting transformations before presenting conclusions. Question 17. How would you handle a stakeholder who challenges your forecast assumptions? I would first understand which assumption they challenge and what operational evidence supports their view. I would compare both positions with historical data, current trading indicators, and external information, then run a sensitivity rather than arguing abstractly. If uncertainty remains, I would present a base case and transparent alternatives, documenting the rationale and owner for each assumption. My goal is not to win the debate, it is to produce a credible forecast and make the risk visible to decision makers. Focus on listening first, clarifying the operational evidence, distinguishing facts from judgment, testing alternatives, documenting assumptions, maintaining respectful challenge, and escalating only when alignment cannot be achieved. Question 18. What would you do if actual results suddenly deteriorated after the forecast was finalized? I would first verify that the movement is genuine and not caused by a posting, timing, or data issue. Then I would isolate the drivers by store, category, and cost line, determine whether they are temporary or structural, and quantify the impact versus the approved forecast. I would alert management early, prepare revised base and downside cases, and identify practical mitigations. I would retain the original forecast for learning, because changing history would hide the forecasting gap. Be sure to mention validating the data, identifying whether the issue is temporary or structural, quantifying the forecast gap, alerting stakeholders, updating scenarios, proposing actions, and preserving accountability without rewriting history. Question 19. How would you prioritize competing FP&A requests during a busy reporting cycle? I would rank requests by decision impact, deadline, materiality, control risk, and dependencies. A board or month-end deliverable would normally take priority over a useful but non-urgent analysis. I would estimate effort, clarify the minimum viable output, and communicate realistic timing rather than silently missing deadlines. Where possible, I would automate recurring work or reuse validated templates. If priorities conflict, I would escalate with options and consequences, allowing the manager to make an informed trade-off. Discuss deadline and decision impact, materiality, dependencies, stakeholder urgency, regulatory or control requirements, effort estimates, transparent communication, automation, and escalating conflicts with proposed alternatives. Question 20. What would success look like for you in your first 6 months at Penny? In the first 6 months, I would aim to understand Penny's store economics, reporting definitions, systems, planning calendar, and key stakeholder relationships. I would deliver accurate month-end analysis reliably, explain variances clearly, and become trusted for responsive, well-controlled work. I would also identify one practical improvement, such as automating a reconciliation or strengthening a forecast driver. Success would mean contributing independently while continuously learning how financial insights can support better commercial and operational decisions. In your answer, combine learning the business and systems, delivering accurate recurring reporting, building stakeholder trust, improving one process, understanding store drivers, and showing measurable contribution without overpromising. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.